So we're doing something a little bit different as we wrap up 2023. We've already got a video out taking a look at the 4 semiconductor stocks that I own in my portfolio, how they've done in 2023, how I think about them looking forward. I'm going to take a look at 4 stocks again today, but instead of looking at a specific sector or industry, I want to talk about my 2 best stock buys of 2023 and my 2 worst stock buys of 2023. I'm Jason Hall. This is Investing Unscripted. But before we get started, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Check out that link after the video. Okay, let's jump right into this. The first stock that we're going to talk about, I'm going to be optimistic. Start off with a good note here. We're going to begin with CrowdStrike. I bought shares of CrowdStrike in early February. The stock has gone on an absolute run. It's not very often we look in our portfolios and see a stock that's basically, for the most part, just mostly gone up for the year. And I was pretty lucky to buy CrowdStrike earlier in the year. The stock was down a ton. It was really a good opportunity, even though there was reason to think that maybe the stock might, in the short term, might go lower. So why has CrowdStrike stock more than doubled so far this year? Up about 100% more than the S&P 500's total returns. Short version, it just keep executing really well. This is a great product, superbly run business, and we know that cybersecurity remains incredibly important. This is not the kind of thing that you see companies just pulling back on their budget. Cyber attacks are becoming more and more prevalent. More things are being done online. More people are working remotely. Add all of these things up, and cybersecurity, with more endpoints and the endpoint protection driven by artificial intelligence that CrowdStrike offers, continues to be more and more in demand. What am I thinking about doing? I can tell you right now, I have no intention to sell my CrowdStrike. This is a stock that I would be far more likely to buy more of than even come close to thinking about selling right now. And the reason why is that this is a business that has gone through its phase of burning cash. We see this is going back to from its IPO, going back from a phase of burning cash, spending money to acquire customers, getting to scale, and then just absolutely pumping out free cash flow. So you see the purple line, this is the dollars in free cash flow, and it has just continues to rise even on a share adjusted basis. This is really important because CrowdStrike does issue a ton of stock with stock-based compensation, but even factoring that in, continues to pump out more and more cash. I believe in this company. George Kurtz has built a wonderful business. He continues to lead it. I have a lot of faith that CrowdStrike is going to remain relevant and continue to be a big winner for me in my portfolio. All right, let's take a look at my second best stock. I want to keep talking about the good ones. It just makes me feel good to talk about the winners. The next one we're going to talk about is Live Oak Bank shares. Anybody that's followed this channel knows that I'm big into banks, follow the banking sector really closely. And earlier this year, when we had a meltdown in the banking sector, we've had 3 major banking failures this year. Live Oak Bank shares stocks went down a ton. I snapped up shares in May. This was right after First Republic failed, was acquired by JP Morgan. I took that opportunity to buy more Live Oak Bank. I've owned the stock for a number of years. I added pretty substantially to my position, and it's gone on an absolute tear. Bank stock that's gone up that much. Still, there's worries about the economy. People are still predicting there might be a recession next year. The Fed might cut interest rates, things that aren't necessarily good for banks. What am I thinking? I'm thinking Live Oak Bank shares is one that I love. Their motto is to be America's bank for small businesses. They've built their lending business on the back of small businesses. They're really good about finding industries that are profitable, that have opportunity for growth, lending really well into them, originating really safe loans. And then their deposit base is based on internet savers, basically. And so they benefit from having a little bit of a decoupled situation with their deposits versus their lending business, even though they are steadily adding a lot of those borrowers, those business borrowers, steadily making them full banking customers as well, building out that full banking business. So again, nowhere near thinking about selling it, but is it a buy right now? I'm going to say that I think the stock is, if it's certainly not cheap, trading for 1.9 times book value and about 21 times forward earnings. I'll tell you, those are certainly multiples that most people are going to look at for banks and be like, yeah, that's way too rich for me. And I'm not going to argue that it's certainly not cheap, but this is a digital bank. They don't have a lot of physical brick and mortar assets. A lot of times when you have those brick and mortar assets, your efficient ratio is much, much lower. And your book value multiple is going to be a lot lower. So that's one of the reasons that book value multiple is higher. And it should be higher because this is a more profitable business because it doesn't have all of those expensive to operate physical assets, the labor costs that come along with that. It's a much more efficient business model. That's why that's higher. 21 times price to forward earnings, not cheap. I don't think that you have to buy this one cheap, though. I think you buy this one at a reasonable multiple. 21 times forward earnings is probably reasonable. It's one that I think you build a position out over time. That's what I've done. So I think this is worth investing a little bit, pay a premium for a premium business. It's certainly paid off for me with Live Oak Bank. I think that's probably the way I would recommend most people consider it. Okay, let's move on. I hate to do it, but it's time to own up to some failure here. Let's talk about my underperforming stocks so far this year. I'm going to kick off one that I talked about in the semiconductor stocks video. This is a stock that from the beginning of the year, down a lot more. It's down 41% from the beginning of the year. But for me, since I bought it in June, it's down about 26% and change. That's losing money. It's underperforming the S&P 500. So what am I thinking? Is it time to cash out, time to sell the loser, time to move on? A lot of people would probably do that, and I can understand why, because Wolfspeed is a risky business. They're burning cash. They're trying to build scale. They're trying to really establish silicon carbide in the analog industrial use, EV, automotive use, semiconductor business. They're spending a lot of money. Again, they're already planning to spend $6.5 billion to grow their capacity and expand and to take more and more market share as silicon carbide becomes more of a standard for analog semiconductors. I'm not going to get into a lot of the details on this company. If you want to know more about it, go watch the video that we just did, taking a look at semiconductor stocks. You're going to learn more about it there. I will say this, again, they're losing money. They're not anticipating getting to operating cash flow until sometime in 2025. So it looked like a year plus 2-year time frame just to get to cash flow positive at the operating level. To get to free cash flow positive, they're saying the end of 2027. So we're talking many years. Investors are going to have to ride out a money-losing business. That's the risk with a company like Wolfspeed. I said in that other video, I would prefer to be adding on strength versus weakness. Want to see some strength in this business, want to see strong performance, and then I'll think about adding to the position there. Okay, time to move on to the fourth stock we're going to talk about. This is my second loser this year, and that is Confluent. I bought shares back in October. Needless to say, I probably should have waited about a month because I bought at the beginning of the month, and then in early November, the company reported earnings, had some stuff in there about guidance, some stuff about a couple of customers that were maybe not going to be doing business with Confluent anymore. And the stock absolutely got pummeled. That's not a great thing to hear. The market did not like the guidance, did not like what the company reported. Now, here's the thing about it. Management circled back around in November and said, let's talk about this a little bit. We still have a massive addressable market, $60 billion addressable market. That was back in 2022. We're expecting the addressable market by 2025 is going to be $100 billion a year. It is growing incredibly, incredibly quickly. And oh, by the way, yeah, you're worried about a couple of our customers and some things that are happening. But you know what? We are big, not just in the cloud, but we are big in proximate as well. And this is where some of those customers that are leaving the cloud are going. So we are where all of our customers want to be. And oh, by the way, we keep growing with them. We're really sticky. We're adding customers. They're spending more money. They're spending even more money. And even our biggest cohort of customers continues to grow. Add all that up, we continue to start to see improvements in leverage too, operating leverage. Our gross margins from 2021 to 2023 have improved substantially. Gross margin on our subscription services continues to improve, and that just broke 80% gross margins. We keep building a bigger business. Our customers, by and large, are sticking with us, and it is a massive addressable market. What did I do? You know what? I didn't just take that loss on my chin. I decided, you know what? This is a business that I know pretty well, that I believe in. I believe in this founder-led management team. I believe in the product. The numbers tell me this is the time to buy. So I took that loss, and on November 2nd, I decided to buy more shares, and they're up 48% since then for me. So this was one of those rare for me. I'm not usually a buy on the dip guy. I'd rather average up in a strong business than average down in a business that's struggling. But I saw a disconnection between the quality of the business and their results and the market's reaction to it based on some fear, based on some things that were happening with a few customers in what is still a relatively small business. I said, okay, you know what? I'm going to take this opportunity to buy. So that's one. It's a short period of time. I've gotten lucky. The real story for Confluent is still going to be written in the years to come, not in the few months that we're talking about with a trade that was down and a trade that was up. It's going to be what the durable business is that management builds, the cash flows that business generates, and their ability to consistently increase cash flow per share over time. Right now, like Wolfspeed, Confluent is burning cash. Didn't add to Wolfspeed because I'm still waiting to see a little more strength on the sales side. With Confluent, happy to buy on that weakness because it was clear to me that the company is delivering. Market got rattled, created an opportunity to add a little bit more. So there you have it. That's the 2 stock buys that I did this year that have been the best for me, and the 2 stock buys so far this year that were the worst for me, plus my thoughts about what to do going forward with those companies.